Okay, so, well, what could be a solution to help prevent this? Well, for me, I call this phase D trading, and that is where we are trading counter, swing, and internal. Now, I've done a whole video on this on our channel, so I'll link this here if you want to go dive into that deeper. But in more simple terms, it basically phase D is when you are taking a trade that is against the swing trend and against the internal trend. So basically almost everything is against you. And I found that for most times, it just wasn't worth trading, and it's worth waiting for a bit more confirmation. Okay, now there are certain times in my plan in which I'll do it, and I have that very more tightly defined now. Basically when we have higher time frame alignment, but again, that's in that video, so I'll leave that for there. The point here, only because I journaled my trades and then spent the time to review them, could I identify a common thing that's causing losses, and that was trading against the trend. So now I've implemented a rule, no more of those trades, and now it's super simple, because when I get the urge to take those trades, I look at my trade plan, realize it's invalid, can't take it. Job done, saves you from a lot of headache and lost money. Next problem, I realized at the end of the quarter, I've taken a lot more break evens than I normally would. So now you have the data, go back and see, and I'm just trying to target too far. So I'm taking the right trade, it is going in the right direction, but maybe I just need to reduce my targets a little bit, okay? Now, obviously reducing your target, it is gonna affect your average risk to reward, but it might increase your strike rate and also increase the actual amount of profit that you bank at the end of the day, okay? Because your winners might be smaller than before, but you might be banking more winners than rather than taking the break evens, right? So one of our coaches, Tomas, he recently reviewed his trades before he was targeting 5R, and in backtesting, that is actually more profitable than targeting 2R in the long run. But actually backtesting and live trading are two very different things. And when it comes to executing live in the market, you can miss one day, whether you're sick or you're just, you're not trading, you're doing something with your real life, and you might miss that day where there's 2 or 3 big winners. And then over the course of the month, your edge doesn't play through. Whereas if you have a smaller target, you're much more likely to hit those targets more frequently. And then by the end of the month, you actually outperform what would have been, if you targeted that 5R. So don't be afraid to have those smaller targets, because in your live trading, it can actually result in better results. Obviously, it's easier for your psychology as well if you're banking those consistent gains. Okay, but that's a whole nother topic. Again, the point, identify the problem because you've got the data, you've journaled and reviewed it, find the reason, then implement a practical solution.